Jack. How are you?
Doing well. How you doing, Joe?
Yeah, not too bad. Not too bad at all. Thanks very much for doing this. I know you're a busy man. In fact, we had to kick this off a little bit late because you were on I'm sure, a call with some sort of state tax agency and whatnot, yelling at them. But yeah, I really appreciate you doing this. For those of you tuning in, thank you very much. And welcome to another edition of Did You Know That? ? The channel where I get to talk to interesting people about interesting things or annoying people about annoying things. And today I have an interesting person talking about a very annoying topic. In fact, I said the word just before, but we'll delve into that shortly. If you're new to the channel, I appreciate you tuning in. If you're a returning visitor, I also appreciate you tuning in, but be sure you're all clicking the subscribe button with the bell so that you get notified as new videos go live, which they will every week. For those of you who may or may not know me, my name is Sean O'Rourke, and while this is a passion project, what I do for a pseudo living, I guess, is I prepare companies to be hacked as a cyber liability consultant, because as I've come to realize after 25 plus years in technology, there's no way to keep them out if they want to get in. So, and that is my fellow Irishman, Jack Sullivan. And Jack, why don't you tell the good folks what you do?
Yes, I'm Jack Sullivan, a tax and corporate lawyer. But we're going to be discussing tax. And I started my firm a little 8 years ago, but I've been doing this for 25 years.
Okay, fair enough. And just for full disclosure, because I am talking to an attorney, Jack was, or still is, the tax attorney for my old IT firm. In fact, you're the one who made us re-architect our entire financial tracking system because as we moved into other states, you said, oh, you got to do that for that state, you got to do that for that state, you got to track this for that state and whatnot. So we are going to be talking about the annoying subject of tax. Corporate taxes, not personal income taxes, and possibly we will focus more on sales tax because Jack and I have had numerous conversations on that topic, and there have been some major changes the last few years on that end. But for the good folks tuning in, Jack, what do you do for companies when they come to you, and why do they come to you?
Well, I mean, basically, I have from a tax perspective, two things. I do tax planning, which is I look at things and help be proactive to minimize their corporate income tax footprint at the federal or the multi-state level, or their sales tax or payroll tax footprint for states all over the country. That's one piece. The second piece is I do tax representation. If a client gets contacted for an audit, whether it be the individual who owns the company or the corporation or the partnership, I represent them in an audit. And I do tons of sales tax audits. I'd say half my practice is sales tax based.
So when do people get in trouble? Let's stick with sales tax for the beginning. When do people get in trouble when it comes to sales tax?
Well, the biggest thing is most people, especially in the home state of New York, which we're talking about, most people don't realize that if they don't charge the tax, then they're personally liable for the tax themselves. So what happens is a lot of people in your industry, IT, moving and storage, event planning, a lot of service-based businesses, for some reason there's this concept that services don't get subject to sales tax. Mm-hmm. And in most jurisdictions, specifically in New York, it is subject to sales tax. I'd say 50% are. Trivial Pursuit, there's no rhyme or reason, but they'll be like, oh, there's no tax on that. And then one or two things happen. An audit happens of another company, and they'll see your company's invoice without charging tax, and they'll write it down, and they'll get contacted, or they just get hit with the audit lottery, and the state just pulls it out for whatever reason. Or they'll have fluctuations in what they're paying in tax, or the revenue on their sales tax return does not equal the revenue on their income tax return, and those things usually trigger. And it doesn't have to be the taxability of what's on the both, but the revenue itself. So if you, on your income tax return, said you had $10 million, right? And you only do business in New York, but your sales tax at $7 million gross, mm-hmm. There's a problem. You will get audited probably almost automatically. Now, some is taxable, some's not. What's taxable is different, but the gross number should be basically the same. That's kind of it in a nutshell.
So there are red flags that go up, obviously.
Yes.
But so we're going to use my old IT firm, which is still in existence. Hi, guys. As a perfect example, IT is a mixture of products and services, especially our type of company, a managed services. So we came to you because we knew the tangible products were taxable, but we didn't know what services were taxable. So you said trivia pursuit in terms of what is taxable, what is not taxable. Is there a rhyme or reason what services are taxable? Or is it simply a matter of politics and somebody says, well, this has got to be taxed, but I don't want that to be taxed, and so on and so forth?
After doing it for 20 years, there's rhyme or reason, but you have to do it for 20 years. But the short answer is no, there is no rhyme. It really is trivial pursuit. Because certain things are taxable and certain things are not, and doesn't make any sense whatsoever. Installation is taxable. Custom software isn't. But off-the-shelf software is. I don't know why that is. If I do remote consulting, right? So you call me up. I mean, we call your firm. They come in and they play around on my computer and do a bunch of things. Arguably, that's not taxable. Yet I come in and I do the same thing. Arguably, that is taxable because they make car installation. How does that make any sense? It just doesn't. So to answer your question, it does, in my opinion, sales tax almost always come down to politics. And I'll give you another example. I represent a lot of IT firms like yours, but I have a huge presence in moving and storage. Very political. I'm actually involved in God knows how many cases. I'm in litigation. And this is taxable, and this isn't taxable, and this is. And the state had a set of rules, and they just expanded it. And they said, well, we're going to make this taxable, and this taxable, and this taxable. Kind of what they did in your industry, right? The law was this, issued all these releases. This is New York we're talking about. And it came down to politics. Small example. Storage, basic regular storage, is taxable. Self-storage is not. Why? Because the self-storage industry lobbied Albany and said, we don't want it to be taxable. We want to treat it like you're renting an apartment. Boom, that happened. The regular storage guys didn't do it. Guess what? Now that's taxable and the other one's not. Your industry really hasn't been good at lobbying, by the way. IT, no. And that's why they just have torn it apart. And that's why you guys are always under audit. Not your firm, but other firms are all over New York because it's just mishmash. Pick this, that, and the other thing. So.
Well, I mean, I'll be perfectly honest. I mean, we had to come to you multiple times because as we offered new services or not new products, but new capabilities and whatnot, we had to determine whether or not those were taxable. And we could do the research, but we couldn't necessarily understand whether or not how they would look at it. So from your perspective, are you giving a best guess sometimes, or do you have to contact the sales tax authority and say, hey, here's what my client is doing. Is this going to be taxable?
Well, generally in my business, I don't guess, and I don't mean it that way. So
yeah,
9.9 times that, right? Yeah. Right. As a lawyer, I'm not guessing. I'll leave that to other people. But 9.9 times out of 10, I know the answer. If it's not clear, because let's imagine your business has always led the way in creating new things. Cloud computing is a great example, right? Yep. Cloud computing didn't exist 15 years ago. As that evolved, right, because you have SaaS, PaaS, and IaaS, right? So as these things evolved, the government didn't know what to do with it. At that point, you make a decision, if you will, you guess, and you say, well, there's no guidance. And under the law, unless it's called an enumerated service, meaning listed out service, we are safe in saying it's not taxable. However, if it's something that's amorphous, it's kind of maybe yes, kind of no, then I would call the government anonymously. I have friends up in Albany, not that they help me out with regards to an answer in the sense that they're going to take my client and help them. I call anonymously and say, hey, we're doing this. Oh, we've never heard of that, is what used to happen in your business for the last 15 years. Now they kind of have it under control. But 10 years ago, they had no idea what was taxable. And I would call them up and like, well, we kind of think we're going to treat it this way on an audit if you ever get caught. And then I would advise a client like yours, I suggest you do charge tax. But I was raised as a businessman in my prior life of the Big Four. My boss always said, you don't let taxes control a business. So I would go to your firm and say, Sean, that new product, you probably should charge tax. However, if you lose a competitive edge, to everyone else out there, then don't do it. But just know you may get taxed, and the state may come in and say you should have charged the tax. Because your business, IT, moving, event planning is very competitive. Phone companies on taxation, right? We've had this discussion before. So sometimes you're like, you know what, Jack, we got this big client. They're saying they're not paying tax. I tell you and your partners, do what you want, but know there's an exposure, and you may or may not charge it. It's not necessarily what you're doing is wrong per se, because it's not clear. You're just making an educated decision knowing that. Because sometimes, right, Sean, you would lose a client because they would say ABC IT isn't charging tax, and you guys are. That's $500 a month. We're not doing it.
And that's what people don't realize is that those numbers add up. I mean, in New York City, it's 8.875% on everything. And you taught me this, in that if a service isn't taxable, but you put it on an invoice, and you can correct me if I'm wrong, with taxable items, technically you're supposed to tax it because you're including it in the whole thing as a bundle.
Right, if you bundle it, yeah.
Right. So what we started doing was issuing multiple invoices, one for taxable items, services and whatnot, and then one without taxable items. And clients actually got annoyed at us. And we told them, we're trying to save you money here.
Right.
I mean, I never understood the logic behind that, though.
Right. So the way it works is bundling means, let's say you're doing 5 things, but you put one line item on the invoice. IT services. But you said IT consulting, and then you don't charge any tax. But meanwhile, you're performing 5 things, some taxable, some not. The state would say, you've bundled the taxable and non-taxable, we're going to tax it all. Right? That's what they do. So what I tell clients is to do one of 2 things. Line item out the invoice, taxable, non-taxable, right? So IT consulting, no. So let's say you give them QuickBooks software, yes. Line item it out, right? But when we talked about it, I said, if you really want to be safe, send separate invoices.
Right.
Because what the state now does, and I just had a call with the state for 2 hours on a moving company of mine, is they look at an invoice holistically now. And now they're taking this concept called the true object test. And they say, well, everything you're kind of doing here, what are you really doing? And they'll say, if we feel the true object is taxable, we'll force the bundling. Oh, yeah. And they'll tax it that way. So that's why when you and I talked a few years ago, I'm like, if you really want to be safe, send out different invoices, and they can't do that. But if you line item it out, it used to be very safe, but now the state is using this concept called the true object test, which is an audit concept. It's not law. They just made it up because it made them more money. So now I'm telling IT clients, event planners, moving companies, I work with a lot of phone companies, whatever you can separate out into separate invoices, they won't bundle. I call it reverse bundling. I did work with a company here in the city that was, they had lifeguards and they did pool cleaning and other things like that. They were reverse bundling them because certain things were taxable, certain things weren't. They said, you know what? The true object is pool maintenance. It's maintenance. We're treating it all. It's like, whoa, the lifeguard. And they went through this whole thing and they've just taken this true object and they've run out of control with it. So that's why when you and I were dealing with it, you made the right decision to separately invoice everything. And then they have nowhere to go. Right. But it can upset your clients a little bit sometimes.
Well, okay, I don't want to get off the rails here because I was about to go on a rant and what have you, because every time you and I talk, we rant. Right. Just to let everybody know, Jack and I have had a working relationship, but we've also had lunch. And I mean, we get flabbergasted. So right now, you just told me something brand new on the sales tax side. But you pointed out the reason why. It's because the states want money.
That's it.
And I've known this for years, but states will go after you vehemently for sales tax items because they think that's where they can really catch you. And they don't care what size you are. No. They're going to go after you.
Right. And the one thing is, keep in mind, if you're an owner of that business, even if you don't charge the tax, you're personally liable in New York State. That's not true of every state. Illinois, California, but you're personally liable. Even if you don't charge the tax. Some states say if you collect the tax and don't remit it, like Texas is like that, they say, okay, well, you collected, you didn't remit it. Now I'm going to go after you personally, Sean O'Rourke. New York says in the statute, if you charge it or should have charged it, and that's black letter law, you, Sean O'Rourke, as the owner, are now personally liable for the tax. So if the assessment comes down for $100 and you're like, I'm never paying this, Sean O'Rourke also gets an invoice from the state of assessment. And they do that very aggressively now. A lot of states you have to collect it. It's called a trust fund tax. You hold it in trust. But now the states have gotten incredibly aggressive, and New York now issues these assessments against the owners all the time once an audit's complete.
That is crazy.
Yes.
I'm glad I'm not working in an industry where I have to worry about the sales tax right now.
Right.
But two, all right, so in terms of companies, people, owners of businesses looking at this now, we've just sort of, not we, you, have just scared the bejesus out of them. How do they know whether or not what they're selling, service-wise, product-wise, and whatnot? Well, if it's a product, it's pretty much universally taxable except for clothing and certain other items and whatnot. But how can they determine whether or not they should be charging tax?
Well, I mean, most services in New York State, unfortunately, New Jersey and Connecticut, a lot of services are taxable. And again, there is no rhyme or reason. Like New Jersey, and I don't know the New Jersey nuances in the weirdo way, but they have all these problems with candy. Some candy is food, and some candy isn't food. So that's how nuanced these things can get. Your business, I think there's upwards of 12 different tax service bureau memorandums or advisory opinions that have been released that talk about what's taxable and not taxable. So to your answer, if you're not sure, if you're selling things, basically here in New York, things you can touch, 9.9 times out of 10, they're taxable. Services, you really have to look into it. I always suggest getting a professional opinion because let's say you decide, you know what we're doing, we don't think is taxable. We're not going to pay any lawyer or CPA or anybody else to research it. You run your business, right, Sean? 3 years pass like it's 2 seconds, right? Mm-hmm. But you're keeping your head down. Now you have 3 years of exposure instead of 1 month, right? So now when the state comes in and audits you, if they come in, they say, oh my God, you should have been taxing this service. You didn't know. Now you have 3 years of exposure, penalties possibly, and always interest. Interest is never waived. So if that's $10,000 going back, you now most likely now owe $20,000. The rule of thumb is it's always double. And then maybe you get the penalties waived the first time. And that's why. So my opinion is always, if you're in an industry that's not really clear, contact someone, get some research done to get an answer. Sure, you can Google it, as Sean knows. You can Google it, yeah. But I can't tell you how many people came in the store before, of course, COVID, that would say, well, we Googled it, and it said it wasn't taxable. Where did you get that from? Yeah. I don't know. And now they're under audit. So I always think it's better, right? The old saying is better to pay someone up front, pay them now, than pay them later. So a little proactivity, especially for a new business owner in the service business, it's good. The industry they're going after right now, service is where they make all their money because everything is so gray. Yeah. Now, the one thing that you don't have to worry about yet in New York, other states you might, the one thing if you're a professional service business, no taxes yet. Accountants, lawyers, architects, things like that, no sales tax. Once you get outside of that realm, it gets crazy. Yeah. Architecture, interior design, the state kind of puts them together. Some things, architects, most of what architects aren't taxable at all, but then they say, oh, maybe that's interior design. And that is partially taxable here in New York City, but not in New York State. And they even parse out the state and the city tax. I'm getting it that way, maybe I'm reversing it. But they parse out things. So you really have to be careful. If you're purely professional service that requires a license, most likely there could be some taxability in your service. Contact someone, sure, do your research, like we all do before we go to the doctor, mm-hmm. But then get that verified because the cost on the back end 3 years from now, and that comes out of your pocket. It's hard to go back to your customers, right, Sean, and get that money.
Yeah. Yeah, I mean, if you're not charging it up front, the customer's not going to pay it in the back end.
Exactly.
And so basically, it's an ounce of prevention is better than a pound of cure.
Great way to put it. Yeah.
So to that end, though, when you do go to somebody, just don't go to somebody who's going to do this as a side favor for you.
Yes, exactly. Yes.
I mean, to your point, the nuances of it are myriad. And that those gray areas, you have to know how to navigate it. So you have to find somebody who's a sales tax expert. And I'm not just saying that for Jack's sake. I'm saying that for the business people who are watching this. Do not trifle with this. We know it firsthand that you don't play games with the sales tax authorities in any state.
Sales tax is the thing that puts people out of business. That's it. You don't collect it. You take aggressive things. You start collecting and non-remitting, which, by the way, is a felony.
Yeah.
People's businesses go down because of sales tax. Sean may remember there was a place here in the city called the Park Avenue Country Club. Do you remember that sports park?
Oh, sure. Yep.
Yeah, they collected like $1 million in sales tax, never gave it up. Those guys ended up in jail. Business closed down. You know, you don't play. Sales tax puts people out of business. I had a French couple. They were doing, basically what they did is they would take a graphic design of a new piece of fabric, and let's say a new design for clothing came out, and then they would make the clothing. So some designers just give you an idea, and they would make the clothing. This is a long process. I learned a lot doing this. This is like 4 years ago. Turned out they owed $1 million in sales tax. They did this proactively, came to me. They left the country because I told them you can come forward and we'll have to tell. And they were very worried because their business was growing. They were reporting a lot more in income, and they were really getting concerned. And I said, listen, you owe $1 million in tax here, which they had no idea. And they sat there and they said, we'll get back to you. I called them a month later. They paid the bill. They had that disconnected off the country. The website was down. Point being is that's the type of thing that can happen. Now, their business took off, but they were petrified.
Sure.
And they left. So you don't want to play around. To Sean's point, you don't want someone who kind of does this. Like when you do trust and estate law. You don't need a guy who kind of is a trust and estate lawyer. Or an IT person who kind of does it.
Yeah, who has to Google how to do most of it and what.
Right, exactly. You need someone who's an expert.
And here's the other point, and this is usually true of any law. Ignorance is not a defense.
No, not at all. No, they don't care. Not at all. And that's always the thing people argue, that's their defense. And one thing that's important to that point is when you're buying things, because we're talking to business owners, anything you buy that you can touch that's an expense to your business, even if there's no sales tax on there, right, Sean? You have something called use tax because you're using it. Don't think because you bought it from Tennessee and they didn't charge the tax that you don't owe something called use tax on your self-reporting when you file your sales tax return. You know, the old Amazon, oh, they're not charging me tax, that's great. Doesn't work that way for business. Didn't work that way for Amazon even technically, but you've got to pay that tax, and that adds up a lot. As you know, Sean, that's a big item for people.
Well, that's the dirty secret between Southeast Pennsylvania and Delaware. Delaware has no sales tax.
Right.
So a lot of people in Pennsylvania drive across the Delaware border to buy their flat screen TV or their big purchase, not a car or anything that has to be registered with the state, to avoid paying the sales tax. Well, technically, the moment they bring it across the border, that's subject to use tax. Now,
correct.
Auditing an individual for use tax is probably not going to happen, but for a business, it will happen.
It's happened a few times. There was a big art thing a few years ago with.
Oh yeah, when you're getting into that.
No, I'm saying, but that otherwise never happens,
yeah.
right?
Yeah.
Never.
They're not going to come after me for my $1,000 TV,
No.
or at least I hope not. I hope they have something better to do. Nope. So, okay, we're talking New York State on this, but sales tax is almost in every state except for Delaware and I think
like 5 states. So, yeah.
5 states. Okay. So if I'm in New York and again, we were an IT company and we started getting clients in other states and we were doing a whole bunch of different things. What determines whether or not we have to charge sales tax in those other states? And this is where I want to get to because we had a long conversation about this Supreme Court ruling. So
right. Years ago, for sales tax, you have to physically go into the state. There was a Supreme Court case called Quill from 1992 that was the standard. So you have to send an employee or an independent contractor. Let's say you're doing work in Maryland, and that person, your IT firm, would have to physically go into Maryland, employee or independent contractor. That would then, you're either pregnant or you're not, you have nexus, you don't. Guy goes in, does work, you now have sales tax nexus for that year. If you're now performing taxable work, you have to register and file collect and remit sales tax in Maryland. That was the old rule. And that went on for years. Then Amazon shows up on the scene 12 years ago, Sean, roughly.
Oh, longer than that, early to mid 90s.
Okay, early mid 90s, but really takes off.
Yes.
Let's say early 2000s, then gets more, right?
Yeah.
So New York, Amazon's located somewhere, I don't know, was it Washington, Texas?
Seattle. Yeah.
Seattle was, right? So then you went to Amazon, why did everyone buy something on Amazon? No tax, right?
Yep.
No sales tax. Eventually New York gets pissed off, and this is New York that does it. They say, screw this, we're not doing that. We're going to start making them collect and remit tax. We're going to pass something called the Amazon law, which was basically, if you advertise, Amazon advertises on a New York website, they click through, this becomes an agency relationship, as if you sent the body in, agency nexus, voila, you now have to charge and collect sales tax law. That kind of becomes the law in certain states, click through nexus. That was the way the law was for a little while. Then it changed and it got worse. I mean, you and I used to argue about this.
Sure.
Then a massive thing comes out, a company called Wayfair, similar to Amazon, comes out. They're doing the same thing. They weren't around as early as Amazon, but they got more aggressive. South Dakota said, screw that. We're passing a statute that says if you have, I think it was 100 transactions or $150,000 of revenue into our state, and they basically called the Wayfair, they said, you have to collect tax. We don't care if you ever come into the state. We don't care about click-through. We don't care about anything. And in the law, they basically wrote it to go to the Supreme Court. Long story short, it went to the Supreme Court. The Supreme Court, which I disagree with, said, you know what, we agree. It's a new digital world. You cross these thresholds. South Dakota, you're right. You can charge the tax. Now, the way the Supreme Court works is technically that only affected South Dakota. But now every state passed a law that mimicked that. So now it's countrywide. I think every state except maybe Missouri has some version of 100 or 200 transactions or $150,000 or $500,000 as the threshold. So basically what you need to do to answer your question is look at how many transactions you have in the state if you never leave your home state and how much dollars you have in that state. Then you have to look it up yourself or hire someone to look it up and say, am I crossing the threshold? As I sit here in my office that I haven't left because of COVID, but I'm selling lamps, right? Out to California, what's my threshold? I think California might be 200 transaction of 500 grand. The minute I cross over, I have an economic nexus threshold I've crossed, and now I have to collect and remit tax as if I'm sending Sean O'Rourke into that jurisdiction. And that's the nexus rule then.
So interesting distinction then. Do I start collecting sales tax at $500,000.01, or do I have to go back and look at that $500,000 and say I should have been collecting sales tax for that amount too?
Depends on the jurisdiction, as you know, I would say. That's different states look at different things. Yeah.
How are you supposed to work around that? I mean, you can't. So in other words, you're going to charge sales tax regardless.
Correct.
Which is how they made it. Okay.
Because I work with a lot of Sean's competitors, as Sean knows, and one of his competitors, we both know the guy, I won't say him, he charges tax on everything. He doesn't even care. In the state of he taxes everybody because he's like, he goes, A, I don't want to pay you, Jack, and B, I don't want to do the research. So he charges tax on everything.
Right.
So to Sean's point, a lot of companies now, because it's all over the front of the New York Times, the Wall Street Journal, it's national news, it was on CNN, Fox News, whatever you watched, it was there. People kind of know about sales tax now. It's become a big thing. So now a lot of people, they just charge the tax. I'm not saying you should or you shouldn't, but some people just don't want to be bothered. And they said, you know what, we're just going to do it because we're going to assume our business is going to grow. Now, let's say you're selling these lamps and you know there's only one time you're selling in Nebraska, you don't do it.
Right.
But if you assume your business is growing, which most businessmen I work with do, a lot of them charge tax out the box just to be careful.
Well, there's an interesting situation going on with IT companies who are partners with Microsoft. There are Microsoft licenses that companies use to tax. They're cloud-based licenses. They're not shrink-wrap software off the shelf. And used to charge sales tax on. Then Microsoft said, nope, you don't have to charge sales tax on. And now all of a sudden, Microsoft may be coming back and saying, certain states you do have to charge sales
Yes,
tax on.
without doubt. Yeah.
Now, those licenses, we don't control, we being the technology companies, don't control those licenses. We basically resell them as partners for Microsoft.
Right.
When you have that kind of back and forth with the provider of the item that you're selling, since we're collecting the revenue, the responsibility is going to be for the partner to collect the sales tax.
Correct.
Does the liability also fall on the partner, or to know whether or not it's taxable, or is that up to Microsoft to tell us?
No, it's up to you. You're the front-facing, you're a retailer, even though people think of walking into Banana Republic. But the term of art is you're a retailer. That is on you. So, and Microsoft has a responsibility too, as well, to know whether they should charge the tax. If they get audited, then meanwhile, you should be, let's assume that it is taxable. You should be giving them a resale certificate.
Yes.
Which they probably know that you're reselling, but you're still responsible to do it. So you give them a resale certificate. Microsoft is in the free and clear, so they're not charging the tax anymore because you're reselling it. And now it's your job to determine whether it's taxable or not. So let's say you're in California, and I was going to reverse, Hawaii and Arizona. One state taxes everything, and the other one doesn't. So I think Hawaii taxes everything, and Arizona doesn't.
That would make sense.
Yeah, that would make sense, right? One liberal, one blue, one red state. So Hawaii, right, you would just assume you have to give the resale certificate and go in that direction. Meanwhile, Arizona, let's say your firm was in Arizona, then Microsoft arguably would know not to charge the tax. And if they were to say, no, we're in Arizona, don't charge us that tax. Now, if there's ever a question, two things, you can self-assess the tax yourself if you want, if you don't have someone you're selling to, or you can go back to Microsoft and say, no, here's the law. You should or should not be charging the tax.
Right.
At the end of the day, you're the retailer. You are front-facing. You have the liability in an audit. You can't blame Microsoft because you, as a business owner, made a decision to go into business for yourself. No one put the gun to your head. A lot of responsibility.
Right.
Part of it is put on your big boy pants and figure out the taxes. And that's what the state will say. We don't care. Right. It's not income tax on your personal income tax return. This is a business. Yeah.
And to your point, then that means you can't. Unfortunately, Microsoft's a multi-billion-dollar corporation, and we're a small micro business, but the responsibility still falls to the small micro business just based on the way the structure, the relationship is with Microsoft.
Yep.
So you have to assume that responsibility. So this is the thing that always annoyed me. There's no uniformity across the sales tax spectrum.
Correct.
Forget about, we'll talk about the differing rates within states and whatnot, but there's no uniformity from state to state on what is taxable, how you collect the tax, and then damn how you remit the tax. I mean, every state has its own website. It's all different. It's all titled something different and whatnot. I'm leading up to this. That Amazon spurring states to tax everything. Wasn't there a push by Amazon to try to create some uniformity among the states, like a central portal where everything is handled the same way for every state, even though the state may tax it differently?
There was a move many years ago. It's kind of fallen away. It's kind of fallen off the lexicon to get a certain amount of states to sign into a compact to have some universality out there. Basically, it's gone quiet. It hasn't gotten enough signatures. And Amazon was a party that was pushing it, but it already existed anyway. Mm-hmm. Some states wanted it to be in this compact, and some states are in it. But at the end of the day, without getting too much into the weeds, the reason it doesn't exist is because of the founding of the country. We are a republic.
Sure.
There's 51 countries in here, right? Because D.C. really is its own state, even though it's not called a state.
Yep.
And they all, as we know, we all live in political time. These states hold on to their sovereignty very tightly. And that's really the answer. Nebraska doesn't want to do things the way New York does things. They want to be their own country. I call them fiefdoms. When I used to send out a newsletter,
Yep.
Sean used to read, I would call them the 50 fiefdoms, even though it's 51. And there's the U.S. Virgin Islands and Guam and stuff, but there's really 51 of these things. And obviously Puerto Rico too. That's its own little jurisdiction, but it is a U.S. entity. So that's the reason why. That's why there's no universality. And they had a bill sitting out there. If they crossed over, I believe it was 2/3 or 3/4, then they felt they could get something through Congress to get everyone on board. But most of the states didn't really want it, to be honest with you. Like New York didn't want to be in it. New Jersey, I believe, was a member. A lot of the states, the flyover states, didn't want it because then they lost their power, their ability also to employ people, right? If everything becomes the same, then a lot of these jobs are lost. I mean, I'll give you New York. New York has its own section of people that review power of attorneys. That's their job. As silly as that sounds, that's their job. I've argued against it. Those people get jobs, and that's a lot of politics, a lot of jobs. California,
a lot of patronage. That's what they call it. It's patronage.
Right? Look at all the big states. You got Florida, Texas. Even though Texas is a red state, turning possibly purple to blue, a lot of jobs in Texas. All sales tax, by the way, no income tax. Massachusetts, New York, Illinois, Florida, California, Arizona, Nevada. These things, those are jobs. They don't want to be all in bed. They want to keep, that's a lot of people on the unemployment line. So once the Amazon law passed, and then once Wayfair passed, you don't hear a lot about it anymore because now the states are like, okay, now we can do whatever we want.
We won. So
we won.
Why do I have to work
exactly
anymore?
We won. And now we'll go out and audit you to death if you don't do it. But originally that was the move. And it died away, thank God. And I didn't like it anyway. I'm against all that stuff. I really am. So
let's get back to New York, because New York's where you and I both are. Again, to the uniformity question, every town and every county within the state of New York has different sales tax numbers.
Great, yes.
Is that on purpose? Was that by accident? How'd it come? Or is that because, again, to your point, fiefdoms within the state, and they're like, I'm controlling this, and I don't care what New York City does?
It's definitely a fiefdom issue. As you know, school districts. In our school district, we have school districts, towns, and counties. And then in between the town and the county, there's this concept of a village. Mm-hmm. So school districts, towns, villages, and counties. So you have all these different governmental levels. The reason why I pick up school districts is if you look at phone companies, which I work with a lot of small phone companies, the school districts can charge their own tax rate too. So I think Long Beach, if you do all the numbers, I think Long Beach is 11.38% sales tax. Oh. So if you live in Long Beach, you pay more in sales tax than for me and Sean, who live in New York City.
Yep.
So it's all that fiefdom stuff. It's a way of allocating revenue. The sales tax return from New York is one of the most complicated in the country. So that is the argument. The good thing is, and there is a good thing, taking New York City out of the equation, every county, because it's all county-based, taxes all services and tangible personal property the same. The only difference is, of course, where we live, which is like Singapore, New York City, which is a city-state. That's what we call it. They have their own rules. Yep. So like interior design, certain other things I won't get into, sometimes taxable, sometimes not. I'd say 95% of the time New York City follows New York State, but 5% it doesn't. There are clothing exemptions.
Exactly. I was about to say right. The clothing exemption is the big one.
Right. And the interior design, there's a few other ones that are out there. But generally, from a land mass perspective, the vast majority of the state plays along with all the services being the same. The rates are all over the place. You got Herkimer County, you got Suffolk County, they're all over. And we're the highest, we're 8875. And to be really stupid, the rate is tiered state, county, and then an MTA. So there's 3 levels of tax here.
Right.
3 levels of tax here. Where most places only 2, it's county and state. So we're kind of in our own little world, unless it's telecom, then there's 4. But that's not complicated, right?
Well, we haven't even gotten into hotels, which have all these fees on them and whatnot. I mean, that's why a hotel in New York City is like $600. Well, it used to be.
Right.
because we're recording this in 2020, so things are a little wonky. But I mean, $600 a night. When you look at the bill, the room was like $200, and then there was $400 in fees and taxes
Right.
on there. Those aren't sales taxes, though, right?
No, those are stadium taxes.
Okay.
Basically, those are the taxes because they don't want people to be furious that they're helping Yankee Stadium, right, or Citi Field, which was built, or New Jersey when New Jersey built the new Meadowlands, whatever the heck they call that thing out there.
MetLife.
What is MetLife Stadium,
MetLife.
which I've heard is not much to see, and I'm a Giant fan. But to do that, where they do, they put those on the hotels and the rental cars. The rental car thing, no one cares, but the tax, they just want to get out. But the hotels, when you look at those rates, like I think it was when Maryland built that stadium, they put on like a 25% tax on a Dallas. Yeah. Dallas was huge.
Right.
Because they don't want the local people to be pissed off. To like, pardon my French, screw the visitors.
Sure.
And you're paying your bill, you don't know it.
Right.
As Sean said, you're walking out the door like, I thought it was $250. And there's like 3 different taxes on there.
Right.
And then they make it more fun. A lot of times what they do, $250 rate. Then they put those other surcharges on top. And then what they do is charge the sales tax on that. So $250,
right.
75 in surcharges instead of $250 sales tax. No, it's $325 is your tax, which is horrible, but that's what they do in a lot of instances.
Well, and to one of your areas of expertise, telecom. I think telecom's the worst, to be perfectly honest, because I look at just my home cable bill every month. It's $90 in fees.
Yeah. Yep.
$90 in fees. So if I calculate that out, it's almost 28%, 29% of my bill is just about fees. Almost 30% of my bill is fees.
Yeah, and that's the thing too, is telecoms, when people look at their cell phone bills, because not everyone has a landline, you look at that, the big number on your bill, no matter where you are, is something called the Universal Service Fund.
Right.
And that's a federal fee that started when Bill Clinton deregulated the phone companies in 1996. That was the Telecommunications Act.
Yep.
And then as a result of that, the reason that happened is we had the internet then. No one knew what a big deal it would be. Clinton saw that, whether you like him or not. He did have some foresight. And he said, we're going to need this internet to touch the whole country. There's no way to do that without building it out, especially in the rural and underprivileged areas. It's both. So you can't argue blue or red here, because that fee, the Universal Service Fund, put the stuff in the middle of Montana as much as it put into the inner city in Memphis. Right. And that's what that fee did. That fee started out at 6%, I'm going to argue. Last time I checked, 17. And it only goes up. And there's a lot of politics behind it. I deal with the Universal Service Administrative Company a lot. I do a lot of federal work. And that number has gone up for years, and there's a lot of reasons for it I won't get into, but that is a huge number. So you're right. When you look at your cell phone bill, your cable company bill, and the USF's not on there, but the other fees and services that that apply to cable that don't apply to phones, they're just massive numbers. Plus, your phone company and your cable company have the right to add little fees on of their own. Which is
call it whatever they want. I mean, they just make marketing names for it and whatnot. But all it is I want a few extra bucks per month out of you.
That's exactly it.
Yeah.
That's exactly it. Yeah.
So when it comes to filing your taxes, some states are monthly, some states are quarterly, some states are annual. Some states depend on how much revenue you make to determine how often that you have to file. You've said it before, if you don't file, you're going to be in trouble along those lines. When you are filing, however, what if you make a mistake? Let's say you're not doing it on purpose, but you make a mistake on your filing. What should people do if it's a couple of years later and they found out they've been making mistakes on their filing, and they come to you and they say, Jack, I've been shorting the state $1,000 a month for 3 years by mistake?
Great. Well, it's a great question. It happens a lot. I had a telecom client who did this exact thing. He was shorting them $5,000 a month for 10 years. He claims he didn't know.
Right.
I don't know if I believe that, but what we did was the numbers are astronomical. And there were other things with it as well. So we sat in the room, the CFO, the CEO, the COO of the company. I said, well, you have two options. And they were trying to sell the company. So when a company gets sold, someone comes in and does due diligence. They would have caught this problem. It was right in front of their eyes. They didn't see it, or they didn't want to see it because they needed the money to run the business.
Sure.
So this is a good example of this. So I sat with them and said, you have two options. Either A, start reporting properly now. Hope you don't get bought for 2 or 3 years. Statute of limitations will run in New York 3 years, meaning they can't look back more than 3 years. And you'll do something called run out the statute.
Yep.
Risky thing to do. You can do it, but it is an option. I'm like, you can try and do that. You can do nothing, which I never recommend. But if once you start reporting properly, they're going to figure it out. So that's a big risk. If you start just reporting properly, the numbers go up, you're probably going to get audited. You do nothing and continue to underreport, you're now continuing to commit a fraudulent criminal act. That's the type of thing that can put you in jail. What I always tell my clients, the best answer is we do an analysis, we understand what the exposure is, and we do a voluntary disclosure, which means we come forward anonymously to the state.
Hold 1 second there. What's anonymously mean?
Okay, so anonymous means you have to hire someone to represent you. Because if you call, if you call right now, they have caller ID or anything else, and you can't continue this charade being the CFO of a company. They're going to eventually figure out who you are. And if you do that, it's not a good idea because you don't know the nuances of the program, you don't know the people that run it, and you don't know the benefits and how to kind of make the system work in your best interest. Because there's different ways. New York's program is different than New York City's, is different than New Jersey, different than Connecticut, different than California. They're all different.
Yep.
Oddly enough, New York doesn't have an anonymous program. You do it online. But generally, I call beforehand to cut a deal because sometimes they go back 6 years instead of 3. Standard's 3 or 4 years. Sometimes they'll go back 6, so I'll contact them. So what you do is you do an analysis. Okay, well, we underreported 60 grand a year, 3 years, 180,000, right? It'll be quick math. When you do a voluntary disclosure, the good thing is there's no penalties. Now, why penalties are important here is you're collecting and not remitting something, let's say. That's, again, a felony. So now I'm protecting you from all penalties, civil and criminal, so you don't end up in chains walking out your door, which does happen, especially if you're a bar or restaurant. They love to arrest guys. Back before COVID, I get emails every day from the state on this stuff. So basically, you come forward, you do an analysis, then you contact the state, you cut a deal, hopefully you get a 3-year look back, and then you say, I'm going to pay the tax, and then you have to pay interest, unfortunately, which is usually a very high rate of like 79%. But now you avoided the penalties, you've come forward voluntarily, and you've solved the problem. Could they audit you? They do a lot, depending on how much the dollar is.
Right.
But the other risk is they find you. And if they find you and you're underreporting, but yet you're collecting, let's say, that can go very, 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 very bad, very quick.
Is it better not to collect?
No. Well,
If you're unsure, is it better to not collect than to collect and not remit?
Yes. If you collect and don't remit, it's felonious. If you don't collect, you're breaking the law, but you wouldn't be going to jail. You would just say, I didn't know.
Right.
But if you collect it, you knew.
Yeah.
My client knew. At the end of the day, I'm like, Bill, you're killing me. Don't lie to me. I mean, like, I know what you're doing. Yeah. Well, we didn't know, and the CPA didn't know. I'm like, you can tell anybody, everyone, not. I do this 25 years. It's okay, but don't tell me you didn't know. Long story short, I actually did keep him out of cuffs. Like, the people in Albany wanted him because it was more than 180. Yeah. It turned out to be $1 million, $1.2 million. And they wanted him in cuffs. And the only reason that didn't happen was because I filed a voluntary disclosure, and I know a lot of people that I could vouch. And they know I only represent real people. He wasn't a criminal. He just didn't really know what he was doing.
Yep.
And I represent him. And they said, you know what? You've been doing this a long time, Mr. Sullivan. We know who you are. You don't represent the bar owners and the guys scamming people. We'll trust you. And otherwise, he would have been in a tremendous amount of trouble.
Well, and let's throw a caveat in here because you are a lawyer. Past results don't necessarily determine future results. So
of course not.
Don't go to Jack and thinking, oh, Jack's going to keep me out of jail.
No, I'm not saying
what
that.
Happens. Yeah.
Boy, Yes. Yes.
So I know the Amazon, when we had our conversation about the Amazon decision, your thing was sales tax was all about the fact
Wayfair
that you're
decision.
getting a Wayfair
Yeah.
decision. I keep calling it Amazon because that's who spurred it, but the court decision was the Wayfair decision. Because you talked about sales tax was, the reason why the nexus is because you were actually getting a benefit from paying the sales tax because you had some sort of nexus within the state. But now that you're not in the state, there's no benefit there. And that was one of your big arguments. So does it pay nowadays, or is there a way for you to avoid sales tax in other states? Can you restrict your sales to only within certain jurisdictions? Or do you think it's not worth the effort and you might lose out on a large percentage of revenue simply because you don't want to deal with the sales tax?
You can not accept clients, right? Like, I'm sure you guys did. I've had clients that have come to me, just an analogy, that I just don't want to work with. So I just don't work with them. So let's say you're running an online business and you don't want to file tax returns in Texas and Nevada and everything else like that. You just don't accept orders. And that happens a lot. It used to happen a lot. Where like we don't ship to, right? You've seen this back in the day, Sean, we're around the same age. We don't ship out west. Maybe the shipping charge is too expensive. You could still do that without a doubt. But then the question is, do you want to run your business that way? Your decision. So a lot of people make those decisions because they don't want the hassle of dealing with it. You know what I'm saying? They don't want to pay tax in all these jurisdictions. So their concern is, I don't want to be in a state that's not right around me in the Northeast. Some people do it. Most people in this day and age don't do it because you can find a solution for the problem, automated or not, and you can get someone to solve that problem. And there's so much competition out there right now for this type of work. I never encourage my clients to do it unless they just don't want their business to be that big,
right?
Which happens, by the way. A lot of people are like, I don't want my business to be, I don't want to go beyond 10 employees, right? Like with your firm, you guys might have been like, you know what, we're going to keep it 15 guys. We don't want to be that too big because I still want to be able to go on vacation twice a year. If I grow into a 150-man firm, I'm the CEO, I'm working 52 weeks a year. So yes, you can stop it. You can definitely have on your website, we don't ship there. Mm-hmm. Now, there are ways to ship to other jurisdictions, but then you're starting to break the law.
Right.
And I don't suggest that. There's really no sales tax planning as much as there used to be with regards to shipping to place A or B. You can decide not to charge the tax, but you're rolling the dice. That's why this law was so important to the states, because it was kind of a nail in the coffin. There's nowhere to go. All my sales tax planning ideas and restructuring companies, they're kind of all gone now.
Yeah.
Used to do drop shipments and things like that. It's really hard. Can you? Yeah, but I don't want to bore your viewers with it. It's very difficult to circumvent the shipping of something into a jurisdiction.
And the moment you figure that out, at some point, the jurisdiction's going to figure that out and probably close the loophole. The loophole anyway.
Right, and that's what they've done. But this is kind of a loophole closer. This thing is, there's ways to do it, but you're kind of doing something. And you do what we call a step transaction. You're taking certain steps for tax avoidance. You talk about that more in an income tax capacity. I do a lot of income tax work as well. You do 3 or 4 things to get around a tax. You may be able to do that here and there. You could, but at the end of the day, they could look right. They call looking through. They could look through the transaction. Like, no, the quote unquote true object is you're avoiding taxation, and the states reserve that sword of Damocles to drop on your head to say, At the end of the day, the service was performed in Nevada. We don't care how you structured it. You owe the tax.
Yeah, and that's the thing. The states have almost free reign. I mean, there's really no restriction on there. They're not like a business where they have to play by a certain set of rules. The state actually makes the rules. Yeah. So, I mean, the fact that they could turn any kind of invoice and say, oh, the objective of this was a taxable service or a taxable outcome, so everything's taxable.
There's only one area you can go to, and that's the courts. But to get a resolution in your favor in a taxing jurisdiction like New York can take years. There was a big case that just came down called Vital Records just 2 weeks ago. That was a moving and storage case. Big change in the industry. That case, they didn't do years. They were under audit. They said, we don't like it. They skipped everything and they went right to a trial court because they knew to get to a trial court in New York State, which could be good or bad, 7-8 years to get there. So they knew that, and then the interest be running. So they're like, you know what, we're just going to not even go to the tax appeals. We're not even letting the audit happen. We're going to go right to the trial court. So to your point, if there's a bad law, it takes forever for you to get to that appellate level, unless you want to pay very skilled litigation lawyers to go right into a trial courtroom, which is scary because if you lose there, the state's like, we won. Yep. And then that's their trump card. Can you appeal? Yes. But at that point, you're in a very difficult spot. So you have to kind of balance it out. I'll give you an example. Ohio had an income tax change in 2005 called the CAT tax. They got rid of their income tax and they kind of put in their own sales tax, which was a gross receipts tax. And basically, it went to the highest court in Ohio. Of course, every court affirmed it. And then basically, no one wanted to appeal to the Supreme Court because they were afraid. So now that economic nexus for income tax is in 12 states. It's not everywhere, like 12 states. But Wayfair is different. Sales tax, we always knew was eventually going to fall. Right. And that's what's happened. And you're right. They could come in and tax everything. That's why, like I said, I believe Hawaii tax it all. Yep. And there's nothing you could do, by the way, because you're not breaking a law. Hawaii's not taxing something that happens in Nevada. That's breaking the law. But they can tax lawyers, CPAs, lamps, anything they want. They can even tax not-for-profits, really, if they want to circumvent it. So you're right. States are countries in America. They really do whatever they want. Yeah. And I mean, that's why I said in the beginning, this is going to be an annoying conversation because it's frustrating. A lot of small businesses are subject to this and really don't realize it or don't want to realize it. But for all the business owners or people thinking of owning a business out there, sales tax is not a game you want to play dice with. Because eventually you will lose. Yes. And the loss is going to hurt. Yep. Okay. We went way beyond the half an hour. I knew it. We did. Good. But I mean, that's just the way this conversation goes because we didn't even get on the fact that once we started my old IT firm, once we started going in the other states, now we had to file income tax. Yes. In those states. So we had to register and file sales tax. Now we had to file income tax returns. Right. Both for the company and us personally, because we were an S Corp and everything was a pass through. And that in and of itself created all sorts of headaches. And that was the other thing that we might do a part 2 on is how you determine where work is done, where the cost is incurred versus where the revenue is incurred. Or realized and whatnot, because that's really what made us restructure our entire financial and tracking system is when you did that audit for us. And I think that would be a great conversation because I think a lot of IT firms wouldn't realize how complicated it can be. That's something we would need to do. I agree because I just did this for another IT firm who had a New Jersey exposure. And the way we sourced they had sales tax, income tax, the owners, everything. I did a voluntary disclosure, did all those things. And I used the New Jersey laws on sourcing the receipts to their benefit for income tax, which meant the income tax number was different than the sales tax number, not the gross number. The taxable numbers were different because of the sourcing rules. And that is nexus rules are different and sourcing rules are vital. Yes. So yes, we should definitely have that conversation at some point. Okay. So there will be a part 2. I can guarantee there will be a part 2 with Jack Sullivan. So Jack, this was great, as I knew it would be. I will give you the honor. This is the longest video I've had so far. Oh, so congratulations. A little clap for you. Oh, thank you. I guarantee the sourcing one will go just as long, if not longer, because that's a really fascinating topic, and we'll save that for another day. But thank you, sir. Thank you, sir. Until the next time, you be well. And to everybody who enjoyed this video, be sure to subscribe. The button down below. If you want to contact Jack, his LinkedIn profile and his website will be in the video description below.
And for Jack Sullivan, I am Sean O'Rourke. Thanks again for turning in to Did You Know That? ? And until the next time, you all take care. See ya.
Bye.